The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Tell Us Why, a podcast for the financial freedom community. If you're looking to succeed in your quest for financial freedom, make sure you join us every week as we, along with our guests, discuss different stories of success, how they were achieved, and how you can do the same. And of course, we ask them to tell us why. Here are your hosts, Jack and Mike.
Welcome to the Tell Us Why podcast. I am your host, Jack Dalrymple, here alongside my co-host, Michael Ketchen. Today we're going to be talking about assets versus liabilities and debt. I know from my days in finance, this probably doesn't sound like the most exciting topic, but it's something that you need to hear. Dave Ramsey is the world's most influential financial personality, and we're here to tell you...
He's wrong.
Are we going to swear about it?
No, he's very wrong.
He's wrong. He's very wrong.
Very, very wrong.
It's your podcast. You say whatever you want.
Yeah, that's right,
I'll
Chrissy.
back you up.
But before we get into that, Mike, what's going on with the business these days?
Things are good. We're making it happen, getting after it like usual. A lot of things moving, just growing the portfolio and always targeting deals within our model. What about you?
I don't know. Can you zoom in on this face? Like Summer John is in full effect.
Oh, my God.
Full effect, Summer John.
Summer John. Well, I know who Summer Jack. I don't know. I know who Summer John is.
Oh, yeah. But, yeah, so been spending some quality time with the family, like
What it's all about.
financially planned for. So.
Financially planned for. I appreciate it. That's a perfect segue.
Yeah.
So before we get into this and explaining you why, in our humble opinion, there is a difference between good debt and bad debt, and it does boil back to assets versus liabilities, let's hear who today's episode is brought to you by.
Are you sick of being treated like just another number by large insurance companies? Do you want a more personalized experience with somebody that you can trust? With Keith Monty from Boynton's Insurance, that's exactly what you'll get. Keith is an experienced professional who can design an insurance plan tailored to fit your specific needs. With access to over 30 insurance carriers, Keith is able to shop numerous markets to find a price that works for you. So if you want an insurance agent that you can rely on and one that has your best interests at heart, then call or text Keith today on 978-241-2363. That's 978-241-2363. Keith Monty. He'll get you covered.
All right, so to clarify, to throw it back before we get into it, because this is actually a perfect story for today. You might have heard of Summer John over here, as you know as Jack. And this is why we've been talking about systems and basically making things turnkey is important. So why don't you tell them,
I never thought of it
John
as a
and
system,
Jack.
but you're right.
So we'll segue in. Go ahead, tell the story.
All right. So when I was employed, my W-2 job, like I said in my Tell Us Why podcast, the first one, I didn't do much. So I had much at all. I had all of my calls going to my desk at my office. It was a 617 number in Boston. I thought it looked cooler than like a 781 local number. So I had all of my phone calls for my real estate business going to my trading floor desk phone. So when people called and asked for John, I didn't know if they were talking about real estate or the business that I was in, the trading that I was in. So for real estate, I transitioned to Jack. So when people called my desk and asked for Jack, I knew it was real estate related. And when they called and asked for John, I knew that it was supposed to be something that I was being paid to do. So that's the Jack
systems.
John story. And now, like, I introduce myself as I'm Jack now. I don't even. It's honestly surprised me that I said John. Like, I don't even know where that came from.
I just thought you stroked out and said the wrong name.
So,
I just went with
luckily,
it. Okay.
his health's okay. His brain might not be. But that's a perfect segue into systems and assets and liabilities and what we want to dive into. And the basis of this episode is going to be a book that I think most people in our space are familiar with. And for those listening who are not, it is very important you read this. And it's also very important the people you discuss it with afterwards. And that book is Rich Dad, Poor Dad. And in my opinion, and in Jack's opinion, I don't know about John, he believes it's also the best definition. So why don't you quickly give us an overview of how Robert Kiyosaki, Godfather of creative finance, defines assets and liabilities?
Yeah, so I mean, very simple terms, the way his simple definition is an asset is something that puts money in your pocket.
Okay.
Just black and white, that's it.
Okay.
So I know most people, in the world think of like their house as an asset. They think of cash balances as an asset. However, in the Kiyosaki definition, and the way that I've used to accumulate wealth and assets, is using Kiyosaki's definition as opposed to a balance sheet definition. I know like accountants and people in the industry, like financial experts, would probably disagree with that. But
the people who charge you fees for their advice and then make money despite of your performance, they have one definition. Be mindful of that.
Yeah.
Goes back to what we said episode 1. If someone's not living the lifestyle you want, take their advice with a grain of salt and probably throw away about 95% of it.
Yeah. I mean, if it's not putting money in your pocket, it's not an asset.
Yes.
Simple.
So what does he define as a liability?
A liability, again, simple definition, anything that takes money out of your pocket. So vacations,
Hold on.
Gold chains.
Can you transform a vacation from a liability to an asset?
Yeah.
You can get into that too.
Yeah.
So real quick, staying with that. So we've got an overview, we've got the definition. So the goal of today, the hope of today's episode is to kind of give you some real life examples of what we've done around assets and liabilities, give you some actionable steps that you can then bring back to the Tell Us Why community. We can define and, basically address and kind of grow and look at this together, all learn from each other. So around that, let's get into some examples. Let's get into the big one right off the bat. The huge one, we did an Instagram live this week, had a bunch of good content on there. Go back and check it out on the Tell Us Why page if you get a chance. Can your primary residence, in the traditional sense, is that an asset or liability? And then in the Kiyosaki Rich Dad, Poor Dad sense, is that an asset or liability?
Well, I think traditionally, like financial advisors, investment professionals, they would say your house is an asset as is.
Okay.
They're wrong. Very wrong.
Why are they wrong?
Because it's not putting money in your pocket.
It's costing you money.
It is costing you
And is it just
money.
costing you your mortgage, sir, your payment?
No, it's not.
Oh, what else is it costing you?
Opportunity cost for one. Insurance.
Well, what is opportunity
principal,
cost?
interest.
I don't know what opportunity cost is. Educate me and the people.
Got to give me a definition now.
No, your
opportunity cost
synopsis of
is
it.
basically, say you have $100,000 you invested in a house. This house isn't making you any money. If you took that $100,000 and put it into an investable asset, maybe that is a house, but a single-family rental, a multifamily rental, it is then making you money. So your opportunity cost in that specific instance would be, instead of the $100,000 going to your house, the opportunity cost of having that $100,000 make you money on top of that $100,000.
Great. There's also appreciation happens, right?
It does.
So let's stay with that example because this is one thing that we leverage a lot in our business and I advise every person to do. If you own a home, listen to me now. Listen to this 3 times. You need to tap into your equity. Let's say you have a house that's worth $300,000 and you owe $100,000 on it. You have $200,000 in your net worth, okay, that is sitting there trapped. Inflation is happening, meaning the cost of goods, the cost of living is going up every year. Appreciation is usually not outpacing that. Some markets it might be, some markets it might not. But over time, they're pretty much neck and neck. I think they try to claim inflation is around 2 to 3%, not real inflation. And then the houses tend to appreciate in good markets at about 4%. So essentially, a home equity line of credit or tapping into that equity allows you to leverage that and get a better return.
So do something like a cash out refinance.
Absolutely. There's other ways to tap into it. And we'll go more in depth with some of these strategies offline in the future episodes.
Tell Us Why community.
That's right.
We can get into it.
Financial freedom community, baby. So it shows you how to leverage that and how to get into that. And that's another way you can transform this liability that's costing you money in terms of the maintenance, the upkeep, the property taxes, the insurance, the debt pay down. You're paying all that and appreciation is not matching that. And again, if the market tanks, interest rates go up, et cetera, et cetera. By tapping into that equity and leveraging it and now getting another investment, it could be another property, it can be starting a business, it can be loaning money. You're getting a spread of 5, 6, 8, 10%, whatever it might be. You're getting a return on your money. You're transforming that liability into an asset.
Yeah, I've worked with investors who have done just that and some of the deals that I've done. So they have a house with basically no debt on it. And again, this asset versus liabilities talk. Like you're not doing anything with this significant sum of cash or equity that you have available. Why not borrow, say it was $100,000, borrow $100,000, get a $100,000 HELOC, and you'll pay, I think it was like 3.25%. It was something ridiculous. It's free money at that point. And I'll give you a significantly more than double return on that investment.
Yep.
So you can make your payments and then get additional money on top of that on a monthly basis.
So you're making cash flow. You're now getting a return that is coming back to you as cash. You're transforming it from a liability to an asset. Let's stay with the housing example before we jump forward. Why is a two-family an asset, whereas a single family is traditionally a liability?
Little house hack situation.
Let's get into it.
A Matthew Hitchcock special.
Let's do it right now. Why is the difference there, Jack?
Well, I was actually looking at a house last weekend, that's a long story. I wanted to look at a house in a very nice town. My wife apparently had no interest in going there. But basically, it was a duplex, for simple terms. It was a duplex, two-family, huge, like 4,500 square feet.
Oh, wow.
Yeah. So basically, it was one side was 2,500, the other side was 2,000 square feet. I could have lived in the bigger unit and only had to pay, I think it was like $1,100.
Okay.
Like principal, interest, everything.
Yeah.
Where my mortgage is now more than double that, living in a single family home.
That you have to pay every month.
That I have to pay every month. So granted, I still would have had to pay a little bit, but there are situations, I mean, it was a $1.25 million home.
Well, let me jump in right there, because this is the point that's very important. Jack, by putting this in this example to work, Jack's paying roughly $30,000 a year, okay? On your mortgage, thereabouts, call it $30,000 a year. That's just the principal, interest, and insurance. Let's say he does about $5K worth of repairs. I mean, I know since I've known you've done a roof, which was an $11,000 repair.
That was fun.
Probably have done a water heater.
You
have landscaping. You have other things you're keeping up with. So Jack's primary residence is essentially costing him $40,000 a year.
It's a money pit when you put it in those terms.
Well, we're going to get into it. We're going to do this right here on air and show just how poor he's thinking this decision. We're talking to you, Kerry. Let him get the duplex. So where I'm going with this example, because I'm going to show you how my brain works real quick, this scary redheaded ginger beard. In this example of $1.2 million, so you're already starting off with a $1.2 million asset, okay? Not only are you getting the bigger asset, you're now getting other people via the other unit to pay down. Not only are they paying down the principal of the asset you have, which in theory is going up over time, it's freeing up, cut it in half, $20,000 for you. You're a pretty good investor. You get good returns. Let's say your typical return is 15% cash on cash. You now take that $20,000, you put that $20,000 to work, you start to get that 15% return. Now it compounds. Yeah. Now over 20 years, that 15% is compounding, and your, $20,000 a year in 15 years is what, roughly $300,000? That compounds. You're probably looking at close. I don't have a calculator in front of me. I'm willing to bet that's probably close to $600,000, if not more. Yeah. Versus right now, you're essentially over those same 15 years in your example. You're setting about $600,000 on fire of your own money. Yeah. Never mind the tax benefits, never mind everything else you get into multifamily. So this is where we say, basically tying it back to the definition of assets and liabilities.
I didn't start the show to be used as an example.
Sorry, we're going there. Essentially, this is why we constantly need to reevaluate our own lot in life. And I'll give a real life example on my side in a second of what is assets and liabilities and why you can't just accept the simple definition that someone gives you. Context matters, okay? That's a real life example where we're talking essentially a $500,000 swing, if not more, after debt pay down and everything else. That if you looked at one bucket versus the other bucket, because what you'll hear, the pundits will say, well, Jack can live debt-free, Jack's house and Hull can appreciate. Okay, so they want to say that. That's great. For that asset to appreciate after you adjust for inflation and everything else, your actual return's probably going to be in the single digits, if anything. Yeah. Versus we just said, putting those dollars to work would probably give you close to a 15 to 20% yield. So these are the little decisions you have to evaluate.
Again, which then to opportunity cost.
Opportunity cost. That now leads back to the example we were discussing earlier. I don't have any car payments right now. It's something we haven't wanted. However, we're starting to get into different tax brackets. So we constantly talk to our CPA to take advantage of certain legal tax code. Essentially, any vehicle that weighs over 6,000 pounds, 100% of it can be depreciated. What does that mean? Does that mean it's exactly what you paid for it? Not exactly.
Section 179? Section 129?
Don't know. We'll put it in the show notes. So essentially, you can write off 100% depreciation of the purchase price of this vehicle, okay? You can finance it at 1.7%. The one that I'm looking at would give me $70,000 in a paper expense. Capital gains tax I don't even know what it's at right now with everything. Call this 20%. If I can lower my taxable income by 70 grand, if that 70,000 was taxed at 20%, it's $14,000 right there. I can finance this vehicle for 1.7%, because that was the other thing I said. Yeah. Should I buy it cash? Well, I don't want a car payment, but they'll give the car loan at 1.79%. I can save my $70,000 and put that money to work, which in my real estate career, I tend to get returns significant, 20, 25, 30%.
You make more than 1%? Oh,
yeah, imagine that.
Cool.
So I have to do a cost-based analysis. I have to look at it through that lens. I have to mentally get out of the spot of worrying about the debt. I have to put the money to work and trust my own process. But we have to constantly evaluate these things. Because then there's the added benefit of, like we mentioned, as we travel around, it's saving on car rentals, it's saving on other things. It's the type of asset you're buying. But when you look at the whole product, even a car payment can technically be an asset in certain scenarios. That's why context matters. So you touched on vacations. Why don't you tell people vacations and go from assets to liabilities?
I don't go on vacations. I go on business trips.
Bingo. What do you mean by that?
Is the IRS listening? Or no, I mean, I obviously, I started my investment portfolio in out of state. And for those assets, I can go check on them as many times. Well, I don't know if there's a legal limit on it, but I don't go that much.
Yep.
So I can go down to those sunny climates and check on my properties, do walkthroughs, or look for more properties to invest in. And
you get to expense.
I get to expense it all.
That entire trip, which lowers your taxable income.
Again,
which is saving,
reducing taxable income. I'm
not
a big fan of paying the government.
No,
I don't know if that's crazy or not, but
no, not. I don't think anyone who's an entrepreneur is. So staying with this example and going through this now on the other side, liabilities, and it leads to the thing you were talking about earlier: debt, good debt, bad debt, etc. What are some examples of liabilities that people can take on that they might be misclassifying?
Everything you buy is liability.
What about like a boat? If I just want a boat to leisurely go around a lake, it makes me feel warm and fuzzy. I really enjoy it, which is fine. They tell me you're supposed to have fun in life. But are these by definition assets or are these liabilities?
I want a boat. I've wanted a boat so badly over the past 5-10 years. And for the life of me, I cannot get myself to burn my money to invest in a boat. Because it is not
explain that. Why is that?
Well, one, it's one of the, I think it's one of the worst depreciating assets there are, unless you're buying a high class yacht. I mean, I'm not, I live in a boating community, but I've never had a boat. I really want a boat, but I'm never going to buy a boat.
Yep. And that's because it is a liability.
Big time liability. I mean, sure, the expense itself up front, or I mean, you can finance it over 20 years. I don't know how those boat loans work, but you're putting gas in it every month. You're
storing it in the winter.
You have to seal it every winter. You have
insurance.
To trailer it. You have to, the insurance. Yeah. There's so many expenses that go along with it. I would love to have a boat. I would love to have $20 billion, and I'd be like, okay, maybe now I'll get a boat. Like, I think it's like the $1 billion mark where I'm getting a boat.
Well, it's funny you bring up the boat. So let's stay with that example of businesses and even the little examples within businesses. It is pretty much proven through tax code, through assets, that if you own a business, there are certain benefits that you tap into once you collect assets within that business. Versus if you lease and you rent everything, you sublet it out. It's fine. It's great to be in business. However, assets are stores of wealth. So for example, you can write off a certain amount of your lease. You can write off certain amounts of your rent, but the income you bring in is still going to be taxed as ordinary income, as self-employment income, higher tax code. The minute you buy a building for your business and you have that business set up in one LLC and then your business rents from that LLC, so you own both companies, these are taxed differently. One is considered active, one is considered passive. So you start to get the tax benefits, which is going to lower your taxable income. So now your business is filled with assets. The other benefit of that as well, you have a physical asset that you can sell outside of the business. You're giving yourself more exit strategies. You might retire and sell the business, keep the asset, and then continue to rent the asset. Another example within business, assets versus liabilities. So it matters what bucket you're putting these into.
One other thing that I'd like to touch on the boat, like buying that boat as a liability. I do want a boat. Like I've thought about this for legitimately 5 years straight.
Yeah.
I have a problem where I don't like to buy things unless they're producing income. Again, Kiyosaki.
Everything through that lens.
Buying a boat decreases my ability to earn money in the future. Mm-hmm. So by putting a down payment or buying a boat cash, like I could buy a house that produces thousands, if not tens of thousands of dollars on a monthly basis. Mm-hmm. Why would I take that? It just kills me. Like it's a problem. It's a problem. Like I have a problem spending money. Like I don't qualify myself as cheap, but I've also noticed that the richest people in the world are generally cheap. Like they don't waste money. They don't frivolously throw money away. They might buy $100,000 boats, but they have assets that are paying for it. And then I guess in another light, if you do really want a boat is something that you want, or a car or whatever, a liability. If you want a liability, use your assets to pay for that liability. So you want a Porsche, it's going to be $1,000 a month. You have $100,000, Porsche is $100,000. Buy an asset that produces $100,000 a month. That asset will pay down the Porsche. $1,000 a month. Sorry. The asset will pay for the Porsche $1,000 a month on a monthly basis, and after 5 years, you still have the asset, and the Porsche is paid off.
And the Porsche paid off by other things. And that's leverage that they talk about, which there was a quote we heard a few weeks ago, and it really struck with me, and it really resonated with me because it's kind of how I grew up, where all poor people have is money. And think about that. Everyone's striving for money. Those who have wealth are striving for assets. The game is set up. We're all playing the same game. Don't play the victim game. Don't blame this guy or that guy or who did what. Anyone can enter the game. And once you enter the game and you start playing the game, you play to win. You start looking at everything through the lens of putting everything in the asset column, it will start to support the liabilities. Too often, consumers do it backwards. The same people who got $1,000 iPhones and $200 sneakers and $2,500 a month rents will be the first ones to cry poor when they're making six-figure incomes. Buy some assets, take the time to invest in the business, go to networking events, listen to podcasts, read books, take actionable steps, and you will start to quickly see your wealth accelerate and your overall quality of life will be supported because you also get time freedom once you start looking at everything through the lens of assets versus liabilities.
And that's another reason why I know the economic divide in the country, the world is an issue, but that's another reason why the rich keep getting richer because they have these assets that keep accruing money.
They go up over time.
I mean, you can do it too. You could have $10,000. If you have to start investing. You have to start buying assets. That $10,000 will turn into $11,000. And someone out there, and I very much agree, the first $100,000 is the hardest.
Yep.
Like if you're making 10% on $10,000, you're making $1,000. You make 10% on 100,000, you're making 10,000.
Now make 10% on a million.
Yeah, you're making 100,000.
And that's where it quickly goes to. And it ties back in to bring it full circle. We mentioned Dave Ramsey at the top of the show. And, some people believe in the philosophy. I'm sure the guy's a great guy. I've never met the guy. Don't really care to.
In some contexts, it makes sense. However, if you have $500,000 in debt.
I mean, so essentially for those who aren't familiar, is Dave Ramsey is straight, do not use any debt. And we're not going to get super in depth with this because the next episode in this series will be about good debt versus bad debt. But we are walking proof that leverage to purchase assets produces wealth.
Debt is good.
I have not met a person who is super successful who does not use leverage or understand debt. And I even argue if you do meet someone who's successful in your own life, if you did a macro view of their business and you introduce leverage into the equation, which you have to be careful, there's a bad side to leverage, but if you introduce good debt into the equation, they would accelerate a lot faster.
Yeah. I mean, even like in a business sense, like if you say debt is bad, does that mean you have no accounts receivable, no accounts payable? Because you're using debt, and even if it's within a month, you're still using debt on a daily basis when you deliver an item and you have an account receivable.
That's a great point.
Or, I mean, like I don't understand why you wouldn't leverage your business. Obviously, you have to be smart about it. I'm not saying go get $1 million in debt when you need $20,000.
Yep.
However, do it intelligently, do it smartly, and use that money, bank's money, to
Put it to work.
and create wealth.
You know what? We should continue this conversation in the Tell Us Why community, where you can also pick up, some great swag? Some bet on
Tell Us Why
yourself.
swag.
Some
Bet on yourself.
So where can they find this Tell Us Why community?
Yeah, so if you don't already follow us on social media, you can find
Everywhere.
us on YouTube, Facebook, Instagram, LinkedIn, Twitter, everywhere, as Mike said. All the links are in the description below. If you're just listening for the first time, make sure you head over to our YouTube channel and subscribe.
Please, all go on iTunes, Spotify, Podbeam, everywhere. Leave a rating and review. That's a huge help. Make sure you click on that and check it out. And even better, if you want to come hang out in person, we record live every Wednesday here in Salem at the 21 Studio Podcast Cafe. And
Studio 21.
Yeah, what is the quote of the week?
So the quote of the week, I went with the Kiyosaki.
Perfect.
In school, we learned that mistakes are bad, and we punish that, and are punished for making them. Yet, if you look at the way humans are designed to learn, we learn by making mistakes. We learn to walk by falling down. If we never fell down, we never learned to walk. And that's a Kiyosaki special. Keep with it, Kiyosaki style.
All right.
So that's it for today. Be sure to join us for next week's episode. And until next week,
Bet on yourself.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.